Welcome to Simple Investing Secrets. In this video, we're going to review the top 12 dividend stocks to buy as inflation protection for your investment portfolio. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Inflation looks less than transitory. Year-over-year consumer price index figures for June 2022 hit 9.1%, shocking economists and Wall Street, who were expecting an 8.8% increase at most. Gasoline prices continue to run high across the country, with the price per gallon hitting more than $7 in some areas. More and more families are reporting tighter grocery budgets due to rising food prices, particularly those of dairy and meat. Having said that, not all is lost for your investment portfolio. Some businesses may profit from inflationary conditions, or at the very least endure less harm. For instance, rising commodity prices can be advantageous for energy stocks. Stocks of consumer goods can keep their margins by raising prices and shifting costs to consumers. Healthcare stocks benefit from evergreen demand due to the essential nature of their products and services. Here is a list of 12 inflation-resistant stocks that also pay dividends. Number 12. Exxon Mobil Corporation, ticker, XOM. Many investors were proclaiming the end for energy sector companies when crude oil prices went negative in March 2020. Since then, crude oil prices have staged a dramatic resurgence, helping to stoke inflation. As a result, energy sector companies involved in oil and gas production have benefited immensely as their balance sheets, income and cash flow improved. A great megacap U.S. energy company to hold is Exxon Mobil. Founded in 1870, Exxon Mobil has grown to over 63,000 employees with operations on 6 continents exploring oil and natural gas and developing petroleum-based products. The stock is up 46.5% year-to-date through July 2022. As of October 2022, the company's dividends was 3.9%. Number 11. Chevron Corporation, ticker, CVX. As one of the main energy sector stocks represented in the Dow Jones Industrial Average, Chevron has been a long-standing blue-chip stock. Currently, the company operates global upstream oil and gas exploration segments, and downstream chemical and petroleum manufacturing, products and transportation. The company is best known by retail investors for its gas station brands such as Chevron, Texaco, and Caltex. Like Exxon Mobil, Chevron has been around since 1879 and has since grown to more than 42,000 employees worldwide with operations around the world. Through July 2022, CVX has increased 25.5% year-over-year. The company's dividend yield as of October 2022 was 3.8%. Number 10. General Mills Incorporated, ticker, GIS. If you've eaten Lucky Charms cereal, Pillsbury dough, Häagen-Dazs ice cream, Totino's pizza rolls or Yoplait yogurt recently, you've had a General Mills product. Coming from humble beginnings in 1928 as a simple flour miller, GIS has expanded over the decades to become a staple in American kitchen pantries and grocery stores. Like many consumer staple stocks, General Mills can maintain margins and profitability even during recessions and inflation, thanks to its ability to pass on costs to consumers. Given how essential its products are, consumer demand is likely to remain high even as household budgets tighten. General Mills is up 10.4% from 2022 through July 2022. As of October 2022, the company's dividends were 2.8%. Number 9. Kellogg Company, ticker, K. Are you familiar with breakfast products like Rice Krispies cereal, Pop-Tart pastries and Eggo waffles? These are all products made by Kellogg, one of America's strongest and longest-standing producers of cereal, snack foods and beverages. As a consumer staples stock, Kellogg's enjoys lower than average volatility, with a beta of 0.34, meaning that it is roughly one-third as sensitive as the overall market. In 2022, strong growth in demand for K-snack products led to an excellent earnings report for the first quarter, with net income up 15% from the same quarter a year prior. International sales were also up, offsetting a small decline in domestic revenue. As of October 2022, the company's dividends were 3.2%. Number 8. CocaCola Company, ticker, KO. When people think of KO as a company, they usually associate it with the red cans of Coca-Cola that everybody loves. However, KO's product lineup doesn't end there. Beyond Coke, KO also sells notable brands of soft drinks like Sprite, Fanta, Minute Maid, Powerade, Gold Peak Tea, and Glaceau Vitamin Water. While its products might be wildly popular in the US, Coca-Cola has also made significant inroads in European, South American, Middle Eastern and Asian markets. The company has grown to over 250 bottling companies, 900 production plants, 27 million retail outlets and 79,000 employees. KO has a strong history of consecutive dividend payouts. As of October 2022, the company's dividends were 2.7%. Number 7. Marathon Petroleum Corporation, ticker, MPC. The U.S. energy sector is dominated by Exxon Mobil and Chevron, which collectively account for around 50% of most energy sector exchange-traded funds, or ETFs. However, investors looking for less mega-cap energy stock exposure can buy MPC, which has a market cap of $46 billion. MPC acts as an independent refiner that supplies gasoline and distillates to resellers and consumers. Currently, the company controls 7 refineries capable of producing 1.8 million barrels of petroleum products per day. With a beta of 1.5, Marathon Petroleum is more volatile than the overall market, but this has worked to its advantage in 2022 as the stock is up 37.5% year-to-date through July 26. As of October 2022, the company's dividends were 2.6%. Number 6. Pfizer Incorporated, ticker, PFE. Pfizer is one of the top healthcare companies in the world. It is known for its COVID-19 vaccine and pill, plus an array of pharmaceutical products that help treat cancer, rare diseases, arthritis, and many other conditions and diseases. The stock has had a challenging year in 2022, with shares falling 19% since January, only marginally better than the S&P 500's 20% decline. Is this the perfect time to buy stock at a discount? Or is it best to avoid it, given the uncertainty it faces around its COVID-19 products? Revenue remains a big question mark. A key reason investors have been bearish on the stock this year is a concern about how strong the company's top line will be in 2023 and beyond. People aren't rushing out to get boosters. Data from the Centers for Disease Control and Prevention show that just half of the adults who have been fully vaccinated for COVID-19 have obtained their first booster shot. Demand looks to be declining, and unless there's a resurgence of COVID-19 cases, that's a trend that's likely going to continue into 2023. For Pfizer, a company that is going to generate around $54 billion in revenue from both of its COVID-19 products this year, out of $102 billion in total revenue, that's troubling news as it suggests there is going to be a significant drop in sales next year. The challenge for the company is how to make up for that shortfall. Pfizer has been acquiring companies within the past year to strengthen its pipeline, but many of those are long-term plays that won't come even close to making up for a decline in COVID-19 revenue. Should you buy Pfizer stock today? Pfizer's future over the next 12 months looks uncertain, but when you're investing over a time frame of 5 years or a decade, there becomes much less pressure for investors to worry about how the company will make up for lost COVID-19 revenue. It could be a challenge, but Pfizer has a pipeline that featured a whopping 104 projects as of July, including 30 that were in late-stage trials. Somewhere along the way, it will develop products that will most likely help generate additional revenue. And if it still falls short, it can seek out more acquisitions. The company has more than $33 billion in cash and short-term investments as of July 2022. With a dividend that yields close to 3.6% right now, Pfizer looks like a steal of a deal. If you're a long-term investor, the short-term worries about the business shouldn't detract from what's still a top business in the healthcare industry. Number 5. Gilead Sciences Incorporated, ticker, GILD. Some of the most innovative and life-saving pharmaceutical products of the 21st century have come from Gilead Sciences. Examples include Tamiflu, an antiviral used to treat influenza, Truvada, an HIV antiretroviral used as a pre-exposure prophylaxis, and Letairis, which is used to treat pulmonary arterial hypertension. In recent years, Gilead has continued to enjoy strong cash flows and earnings thanks to strong demand for its antiviral drug Veklury, also known as remdesivir, which is used to treat acute COVID-19 cases. For the first quarter, Gilead generated $1.5 billion in sales, smashing analyst expectations by $400 million. The company's dividend yield was 4.8% as of October 2022. Number 4. Halliburton Company, ticker, HAL. Halliburton is a leading U.S. oilfield services company. Even after gaining 68.3% year-to-date as of November 2022, Halliburton shares remain attractively valued at just 13 times forward earnings. Analyst Chase Mulvihill says investors don't fully appreciate Halliburton's favorable positioning in international markets. Halliburton reported 20% international revenue growth in the first 9 months of 2022 compared with 17% growth for competitor Schlumberger Limited. Halliburton has used its sizable free cash flow generation in the past 12 months to rapidly de-risk and deleverage its balance sheet. Bank of America has a buy rating and a $38 price target for HAL stock, which closed at $38.48 in November of 2022. Number 3. Advanced Micro Devices Incorporated, ticker, AMD. Semiconductor company Advanced Micro Devices produces personal computer central processing units and graphics processing units, and it has been gaining market share from leader Intel Corporation. New product ramps, including its 5nm server chips, will help AMD maintain its data center momentum in 2023 and continue to chip away at Intel's server chip market share. Despite AMD maintaining impressive 29% revenue growth in the third quarter, its stock is down about 57% year to date as of November 2022. Bank of America has a buy rating and $82 price target for AMD stock, which closed at $62.19 on November 4, 2022. Number 2. Devon Energy, ticker, DVN. The case for Devon Energy is that it is operating well in a favorable environment. This can easily be seen on the top and bottom lines, with revenues up nearly 138% year over year in the second quarter, and earnings per share up nearly sevenfold. Several factors are driving an indisputably good earnings report. First, energy prices peaked near $120 per barrel in the second quarter, up roughly 60% for the year to date at that point, against which current financial comparisons are made. So just by staying open for business, Devon was poised for a big bump in revenues. On top of rising prices, DVN has increased production and has the reserves to keep doing so. For the most recently reported quarter, Devon delivered about 300,000 barrels of oil per day, about 4% above the midpoint of its guidance. Finally, Devon is committed to reducing the company's share count through buybacks. Through the first half of 2022, Devon reduced its share count by 6% via $1.2 billion in buybacks. And the board increased its share repurchase program by 25% in May. Like many oil companies, the more oil they produce, the better their margins. Devon delivered a $60 field level operating margin in the second quarter, versus just over $42 at the end of last year, an increase of 42%. Big is beautiful in the oil patch. Companies committed to buybacks are often committed to dividend expansion, and Devon is no exception. Concurrent with the second quarter report, Devon announced a $1.55 per share dividend payment, marking a 22% increase over Q1. DVN employs a fixed plus variable scheme for its dividend. In the most recent quarter, 2 cents per share was allocated to the fixed portion, or 13% of the total increase, which investors might see as a sign of confidence by management. Notably, the current dividend yield for Devon is an eye-popping 9.1%, making DVN among the best inflation stocks for those seeking income. However, it also indicates that investors are a little more skeptical that the company can keep the oil and the cash flowing. Devon, on the other hand, is still confident after purchasing Validus Energy for $1.8 billion in early August, increasing its exposure to the Eagle Ford Play's all-import potential. The company had a dividend yield of 9.1% as of October 2022. Number 1. Costco Wholesale, ticker, COST. Costco Wholesale is a perennial favorite, and for good reason. The company's nimble management team consistently increases earnings in good times and bad. As proof of this, for at least the last decade, Costco has delivered record earnings each year. The company's stock has performed moderately in 2022, which is even better, at least for the time being, as it allayed investors' concerns about purchasing one of the best stocks for inflation before it went up in price. There is a moderating point. Costco trades at a price-to-earnings multiple higher than its peers according to Value Line. But there's a case to be made that Costco earns its premium valuation. One way it does this is by managing the costs of and pricing for the goods it sells to customers. Especially now, in an era of historic inflation. In the 9 months that ended May of 2022, sales were up more than 16%, but the gross margin, sales less cost of sales, retreated only just 70 basis points, or 0.70%. Next, Costco is a dividend grower. The dividend is small, about 0.7%, but investors might be encouraged that the company has grown it at an average 13% clip annually for the last decade. This says a lot about astute and prudent management. For really long-term investors, the growth in the dividend can pile up and produce spectacular cash-on-cash returns. Finally, Value Line rates Costco A++ for financial strength when considering items such as free cash flow, which is the money left over after a company has covered the capital expenditures required to grow its business, debt, and return on equity. Walmart is the only other retailer to receive an A++ rating, but WMT is a completely different animal. Costco's dividend yield as of October 2022 was 0.7%. Which of these dividend stocks would you consider purchasing for your investment portfolio as protection against inflation? Let us know in the comment below. For weekly updates on the top stocks to buy and cutting-edge investment strategies for wealth creation, don't forget to like this video and subscribe to our channel. Thank you for watching, and happy investing.